When bad news hits, most traders panic. Here's what actually happens. March 2020. COVID crashes the market 34% in 23 days. Retail investors lose $4.6 trillion selling everything. But here's the crazy part. Warren Buffett bought $24 billion in stocks during that exact same period. Why? Because he understood something most traders don't. Markets don't react to bad news the way you think they do. In the next 8 minutes, I'm going to show you the actual psychological pattern markets follow when disaster strikes, and how you can use it to your advantage instead of getting crushed by it. By the end of this video, you'll never look at market crashes the same way again. Section 1. The Credibility Builder. I'm your name, and here at the Market Ledger, we break down complex market mechanics into simple, actionable insights for business professionals and investors. Before we dive in, if you're new here, hit that subscribe button and turn on notifications. We drop one deep dive video every week that could literally change how you think about markets. Now let me show you something fascinating that happened just recent example. Section 2. The Framework Introduction. Markets react to bad news in 4 predictable phases. I call this the bad news reaction cycle. Phase 1, the knee-jerk panic. Phase 2, the reality check. Phase 3, the divergence. Phase 4, the new normal understanding. These 4 phases is literally the difference between losing money in a crash and positioning yourself to profit from recovery. Let me break down each phase with real examples. Section 3, Phase 1. Deep dive. Phase 1, the knee-jerk panic. This happens in the first 24 to 72 hours after bad news breaks. Here's what's happening psychologically. Your brain's amygdala, the fear center, takes over. Rational thinking shuts down. Everyone's asking, how bad could this get? And here's the critical part. Phase 1 reactions are always overreactions. Look at this chart. Lehman Brothers collapse. S&P drops 8% in 2 days. Brexit vote, market tanks 6% overnight. Silicon Valley Bank failure, financial stocks plummet 15%. But watch what happens next in every single case. The market recovers 40 to 60% of those losses within 1 week. Why? Because Phase 1 is emotion, not analysis. It's algorithmic trading, stop losses triggering, and retail investors hitting the sell button in fear. Professional investors, they're sitting on their hands, watching, waiting for Phase 2. Engagement checkpoint. Quick question for you. Have you ever panic sold during a market drop? Drop us hawk in the comments. Let's see how common this actually is. And while you're down there, smash that like button if you're finding this valuable. It tells YouTube to show this to more people who need to hear this. Okay, Phase 2. This is where it gets interesting. Section 4. Phase 2, Deep Dive. Phase 2, the reality check. This hits 3 to 7 days after the initial news. Now analysts have had time to actually run the numbers. Here's what changes. The question shifts from how bad could this get to how bad is this really? Let me show you a perfect example. March 2023, Silicon Valley Bank collapses. Initial panic. Banking sector crashes 15%. But then, Phase 2 kicks in. Analysts start modeling. Only 3 banks have similar risk profiles. FDIC backstops prevent contagion. Fed opens emergency lending facility. Big banks are well-capitalized. Result? Within 10 days, the market recovers 70% of banking sector losses. The bad news didn't change, but the analysis of the bad news created a reality check. This is the phase where fortunes are made, because most retail investors are still in panic mode while institutions are quietly buying. Section 5, Phase 3, Deep Dive. Phase 3, the divergence. Week 2 to Week 4. This is where the market gets smart and ruthless. In Phase 3, the market stops treating everything the same. It starts asking, who's actually hurt by this and who's not? Watch what happened during COVID. Bad news, global pandemic shuts down the economy. But look at the divergence. Travel and hospitality. Down 60% took 2 years to recover. Energy, down 45%. Slow recovery. Technology, down 12%, recovered in 3 months. E-commerce, actually UP 25% during the crash. Same bad news, completely different outcomes. Here's the key insight. By phase 3, the market has done its homework. It knows exactly who's vulnerable and who's positioned to benefit. If you're still treating the market as one thing in phase 3, you're going to make terrible decisions. This is where sector rotation strategies dominate. The money doesn't leave the market, it just moves from losers to winners. Section 6, Phase 4. Deep Dive. Phase 4, the new normal month. 2 onwards. The bad news is now just news. It's been priced in. The market has adapted. Life goes on. But here's what's fascinating. Phase 4 reveals permanent structural changes. Post-2008 financial crisis, banking regulations tighten forever, too big to fail becomes policy, low interest rates become the new baseline. Post-COVID, remote work explodes permanently, digital payments accelerate. 5 years forward, supply chain restructuring begins. The market in Phase 4 isn't the same market you started with in Phase 1. Smart investors don't ask, when will things go back to normal? They ask, what is the new normal? Section 7, the actionable takeaway. Okay, so how do you actually use this framework? Here's your action plan for the next time. Bad news hits. Phase 1. Checklist, do nothing for 48 hours. Seriously, just watch. If you must act, only reduce position size, never sell everything. Start building a watch list of quality stocks getting crushed. Phase 2. Checklist, read analyst reports. What's the actual damage? Compare to historical similar events. If fundamentals haven't changed, start dollar cost averaging into positions. Phase 3. Checklist, identify divergence. Which sectors are recovering, which aren't. Rotate capital from permanently damaged to resilient sectors. This is your primary buying window. Phase 4. Checklist. What structural changes are permanent? Adjust your portfolio strategy to the new reality. Set up alerts for the next cycle. Remember, the goal isn't to predict bad news. It's to have a response framework ready so you don't make emotional decisions in the moment. Here's the truth that separates professional investors from amateurs. Amateurs see bad news and panic. Professionals see bad news and recognize patterns. The market will crash again. Bad news will happen. But now you know the 4-phase cycle. You understand that Phase 1 is always an overreaction. You know Phase 3 is where the real opportunities emerge. You recognize that Phase 4 demands strategic adaptation. This framework has played out in every major market event for the past 50 years, and it'll play out in the next one too. Want to dive deeper into market psychology? Check out this video next, where I break down the behavioral finance mistakes that cost investors millions every year. And if you haven't already, subscribe to the Market Ledger. We're building a community of informed investors who understand how markets actually work, not just what they're doing. Thanks for watching. I'll see you in the next one.